Debt is on the mind of many of us. There are many different types of debt. Some debt is to further education, and other debt is needed to be able to function as a working person. All debt has its place in our budget, but we get into trouble when our debt exceeds our income coming in. In this presentation, we will be discussing two types of debt: credit card debt and student loan debt. They are the most difficult of debts to pay off and often feel like the most overwhelming. Don't despair. There are ways to help you manage your debt effectively so that you may be able to save more for your future. Your credit report will give you a good summary of your lenders and amount of debt outstanding. By law, each of the 3 credit bureaus, Equifax, Experian, and TransUnion, they must share your credit report for free upon your request. Be sure to check your credit report frequently to make sure all information is reported correctly. Let's look at some signs that may indicate that someone is carrying too much debt. Some of these signs are overwhelming and hard to climb out of. None of us like to feel as though we are not moving ahead and feeling sometimes always behind. Sleepless nights and worry can wreak havoc on your health. So we need to understand the reasons behind the debt accumulation before we move forward. When you are assessing your debt and evaluating your budget to pay off the debt, you can't miss a very important step: figuring out why you developed debt in the first place. Some debt, like student loans, are easy to understand and process. Excessive spending on credit cards might need intervention. Using a credit card to handle medical expenses might indicate a need for a better plan for insurance. Analyze your debt carefully and then develop a plan that includes some letting go and some reduction of spending. There might be trade-offs when reducing debt. Your budget, a diary of your spending habits and needs, will tell you where the trade-offs may be. Including a professional financial guide in your plan might be worth it to you. There are professionals that can help guide you through the debt reduction process. Let's talk about credit card debt in a little more detail. Sometimes credit card debt comes from overspending, and sometimes it comes from having to use the credit card because of illness or other emergencies. Having the debt stare at us every month feels the same no matter what the cause initially. What does it look like to pay off the minimum amount every month? Let's look at an example where you may have $4,000 outstanding in credit card debt. If you pay the minimum payment each month of $80 and make no additional charges, it would take you 24 years to pay off that debt, assuming a 16% interest rate. And the debt over that period would have grown to $10,659. And this includes the interest. If you increase the payment to $141 a month, a bit beyond the minimum with the same 16% interest, it would take 3 years to pay off, and the total debt and interest would be only $5,063. $5,000 less than if you had paid only the minimum amount. There are ways to calculate this and get your life back. A financial advisor can help. Some of the ways include just monitoring your spending, paying attention to your budget, thinking about what your long-term and short goals are and saving for those goals. Do you want to save for a car? Factor that into the equation. When looking at your spending, your budget, what do you see that are your needs versus your wants? What can be used as trade-offs? If your employer will allow, try to automate savings. Just a few dollars taken automatically out of a paycheck every month can make a substantial difference in your rainy day fund. You probably won't even miss it. and you need to establish a plan for emergencies. What if the car breaks down? Or you have to have surgery and pay the out-of-pocket deductible and copays? Or what if your water heater blows a gasket? All these issues need to be included in your emergency plan so that you have the savings to pay for these emergencies and not have to rely on credit card debt. And as you think about your credit card debt, after you've done your research, you may want to see how much you're paying per month on all your credit card balances. There are options that you can consolidate your loans, or maybe take a strategy where you're paying the credit cards that have the highest interest rate first, or maybe the credit cards that have the lowest balance to knock them out of the way. The second type of debt we will discuss is student loans. There are a variety of ways that you can pay back your student loan, particularly federal student loans. The first step is knowing what type of federal loan you have. The type of loan will determine what repayment options are available to you. You may have a direct loan, PLUS loan, Stafford loan, or Perkins loan. These loans may be subsidized or unsubsidized, and there are options to consolidate these loans as well. For some loans, they are standard loans where you have a level payment and you have 10 years to repay. A graduated loan, you also have 10 years to repay, but the payments are lower in the beginning and they increase over the 10-year period. The extended option gives you up to 25 years to repay. For this option, payments can be fixed or graduated. While this option may help you with manageable payments, you may end up paying more in interest over that time period. If you are experiencing hardships, there are options that will help you better manage your student loans. These payment options are based on your household income. As your household income increases, your payments will increase as well. You may have thought grades were only for school. In the school of life, how you manage your debt also gets a grade. The grade is based on a scoring system. The most popular credit score system is FICO, paying on time, and then how much credit you are using. Those two aspects are weighted the highest when looking at your FICO scores. The higher your credit score, the better interest rate you get on loans, whether it's a mortgage or a car loan. So let's take a look at how interest rates affect cash in your pockets. The lower the interest rate that you're charged for loans, the less money you pay in interest. On the other hand, the higher the interest rate, the more you will pay in interest. Now that you know what your debt is and why you have accumulated the debt, you will be able to better manage your debt. Create a strategy that has the best outcome for you. Don't be afraid to ask for help along the way. There are experts who really understand this type of debt management. Getting out of debt is a complicated journey. Remember, don't forget to save along the way. Even $5 a week will make a difference to some of your long-term and short-term goals.